you're using, capital to kind of accelerate things that are already going well, not to jumpstart things. Is that a fair characterization?
Yeah, I think yeah, when the opportunity um, isn't pulling you forward, it's not time to raise money. I mean, it has to be there. It has to be tangible. Either a customer saying they want this and they'll pay for it, or some other like direct relationship you've built outside that is going to um, purchase your product or use your product. But the opportunity has to be bigger than just your idea, and it's got to be tangible. Yeah.
A lot of founders assume raising venture capital is just part of the process. You have an idea, build a deck, find some investors, and start pitching. But what if you don't actually need the money yet? My guest is Elia Wallen, founder and CEO of Engine, a business travel platform valued at $2 billion. We talk about why raising too much too soon can lead founders astray, how to know when your company is actually ready for outside capital, and why the opportunity should be pulling you forward before you start pitching investors. I'm Walter Thompson. This is Fund, Build, Scale. Fund, Build, Scale is for anyone who's interested in learning the basic skills required to launch a startup, secure initial funding, and transform their idea into a sustainable business. Get the newsletter on Beehive or LinkedIn, and subscribe wherever you get your podcasts. And if you like what you hear, please leave a rating or review. Eli, thanks again for joining me today. I really appreciate the time.
Thanks, Walter. Yeah, thanks for having me.
So, for listeners who haven't heard of Engine yet, what exactly does the company do today?
Yeah, we're a modern travel management and spend platform. We service over 33,000 businesses and over 1 million travelers.
Engine wasn't your first startup, your first company you bootstrapped. And I'm kind of curious how that experience taught you or how that experience informed your approach to institutional money.
Yeah, I didn't know any better, Walter. Early on, I didn't understand the VC or private equity world at all, and I thought to grow a business, you needed to just figure it out with the money that you could scrape together from friends or family, and obviously what the business could generate. And so I think it shaped me and the companies that I built in a tremendous way. Not having access to a bunch of cash early on certainly makes you make different decisions. And I'd like to think in our case, better decisions. We were much more resilient. I think creative, scrappy, inventive, and it worked out well for us.
How long ago did you found Engine?
Engine, we're about 10 years in.
There must be a point when you probably don't realize it, but there was a point when I guess you started to realize you understood more about venture capital, or you understood venture capital on a base level that you couldn't understand from the outside.
Yeah, I think it's when venture capital started calling. Into Traveler Saved, my first company. The business was growing, and I think they could see some signal of the business expanding, and so people started to call in, and I started taking some calls and started to lean into understanding that space more.
I mean, when you look back at yourself, like, do you think were you skeptical? Were you, I mean, actually, no, I don't want to characterize it, but like, when you look back at your previous self, your previous experience, how naive do you think you were, I guess, in retrospect?
Yeah, yeah. I was certainly skeptical. I was very naive. But again, I think in some cases, ignorance is bliss. It did help me. It allowed us to stay very, very focused in the business. I remember telling some friends later on, as we were about to take on our first money, that I was looking forward to having a board. I was looking forward to having some of the folks around me to help guide the business as it got bigger. But I do think early days, if you gave me a check for any significant number, um, I don't know if we would have been as smart in spending that, deploying that capital as we would have been later on.
Mhm.
So I think early days, you still make a lot of mistakes, but those mistakes aren't as big because they can't be. And so I think you get the opportunity to learn more about what works and what doesn't, and the stakes are a bit smaller because you don't have large sums of money at your disposal.
At that very early pre-VC stage, do you think you were craving like structure or accountability in some form?
I think accountability. Yeah, I knew that I didn't know everything, right? And I didn't know what I didn't know too. And so there's certainly a desire to bring in some folks that could help me scale as we grew. And I tried to do that through hiring. Um, And frankly, I think there was some great wins out of that, but also when you're trying to like really force something, kind of get unnatural, it doesn't really work. It didn't work for us much. So when I tried to hire a big person from a large organization to come into this kind of scrappy startup, oil and water, it's just such a different world.
Yeah.
And it took me several hires to figure that out, that we were going to have to build this kind of from the inside out, as well as find those people that were right for the stage that we were at the time.
Yeah, it's hard to go from, the corporate cafeteria to the Costco snack run. It's a bit of a step down.
Absolutely.
You said like there's a lot of pressure on validation on early stage, seed stage founders. Like what did you mean by that? What does that look like?
Yeah, I mean, you're grinding, you're working the late hours, you're building the team, and when you can do a press release and tell the world that someone else believes in you and wrote a big check, it helps a lot. It helps in a lot of ways. It certainly helps internally with your employees. It helps with probably spouses and significant others wondering what you're doing so late, like the late hours grinding. But I also think some people do it for the wrong reasons, and sometimes that can be ego, it can be pride, it can be, um, I mean, the validation aside, what do you actually need the money for? And if you can't really articulate that, it's more about ego, um, it's a mistake, no doubt.
It's a lonely life of a founder, certainly. It's all very much up in your head, I imagine, a lot of it. How do you distinguish between I need capital and I need reassurance validation? Like how do you pressure test that, I guess?
Yeah, I mean, I would do the validation as a far down the priority list, and it's a nice to have. It comes with it, but frankly, if that's why you're doing it, if that's the top priority, I would just say you're misguided. So if you need the money, if your business has product market fit, if you do see some success, and the money is a way to scale that up, then more power to you. I would still say be cautious on how much you take. It's going to be the most expensive money you've ever raised in your life, probably. And it's very, very expensive to do too much too soon, for all the reasons, right? If you give me a really big check before I'm ready to do that, if you give me a car when I'm 10, I'm probably going to crash it, right? The people that win the lotto, not all of them, but certainly some get the money, and they don't know kind of how to manage it, and they spend it recklessly, and they're back to where they were before that. And so I think that goes for a lot of businesses that raise money too much too soon.
Mhm. I mean, I've lived in the Bay Area like most of my life at this point, so I've seen the cycles kind of come and go. I've seen, the Herman Miller Aeron chairs really cheap on Craigslist. I've seen the mahogany teak foosball tables. Something you said in our prep call is that money makes you do wild things. Um, what are some of the most common wild things you've seen founders kind of just slip
I
into?
mean, what you just said. I mean, parties, events, hiring way too much too soon before the systems or the business can actually absorb those folks. Um, so I think you get overzealous and you see the money, and you have people that literally just gave you the money say, spend it. Or why did I just give it to you? And so there's pressure on them to spend the money. But it takes time to understand where the best use of funds should go. Where do you need to spend the money? Where do you want to spend the money? And there's going to be things that you didn't see that you're going to have to deploy some money on. And so it can just be the expenses and the errors just become that much bigger.
Mhm.
And there will still be a lot of mistakes. You're still going to learn so much. But when those mistakes are smaller, they're more constrained, because you don't have that much money in the bank. You're just going to be that much smarter off when you actually do get the money.
Did you have an office before COVID?
We did have an office before COVID. It was a shared office. So one thing with my previous company, we were shared. We were tightly coupled. Office, shared services, same accounting team, same payroll, all the things that we were just trying to share, um, to get as scrappy as we could. I mean, literally notepads you'd have to write on both sides of the paper. You're not just handing those things out. So I mean, it got down to that point of it was just waste, and waste was money, and we didn't have a lot of it, and so we had to be smart. So I mean, ways that we would share licenses, even SaaS licenses, I had to say, we would do literally everything to keep those costs down.
Were you building in San Francisco? Where were you at that point?
No, we were in Denver.
I haven't lived in Denver, so I don't know, right? But I don't know if it's like, San Francisco where you go to a cafe and you can't, swing at your backpack without hitting some guy who's working on their pitch deck or whomever.
Yeah.
So but there's a certain culture
Yeah,
there. Kind of you go out, you spend money, you go out and you're seen, and you do the things, and you have meetups, and
yeah.
there's a certain performative aspect, I think, to being a founder. I think in the Bay Area and spending that money. If you were going to be in the Bay Area, how do you not fall into that trap? How do you
I
resist
mean,
the pull?
I never got off on that. That was not my thing. I did not, I didn't care about the accolades. I didn't care about the press releases and stuff. I mean, we did some of it once we did the raises for the validation to, help primarily with talent. That was the number one driving reason. And I get it was competitive. I mean, Denver had a great entrepreneurial community, it still does. It's just much different. And so I wasn't early in San Francisco, so I don't know that full pool, right, to the show me state kind of thing. So,
Mhm.
but I mean, it was certainly in Denver too, but we were just like, let's build a great business, and that speaks for itself. And I think that was what we were always about, and it wasn't that much else outside of that.
I want to talk for a bit now about kind of the question of how much money do you actually need if you're going to raise outside money, and just pressure testing some of those assumptions around runway and fundraising size. In our prep call, you mentioned that founders like they sometimes throw out like really absurd fundraising numbers without really interrogating them first.
Yeah.
So if you were having coffee with someone today, like a first time pre-seed founder who's getting ready to meet an investor next week and they're working on their deck, how do you check them to make sure that they really needed to take this meeting in the
Yeah.
first place?
To your point, it's just pressure test it. Pressure test yourself. I literally just did this with someone the other day, and he wanted to raise about $2 million, and I said, "Well, let's break it down. What do you need?" And he was in the hardware space, a smaller, more affordable, not massive hardware, and um, we got it down, and the guy really needed like 800 grand to do everything that he needed to do to get to the next stage where it would make sense for him to do another round if the company was successful. So he was going to take $1.2 million more than he needed. And I just told him how expensive that was. And yes, I get, well, rainy days. And I mean, in the 800 grand, he still had some money. He had some padding, he had some cushion, but he really didn't need all that money. And I think that was more just a number that he had in his head. Listen, he's a super smart guy building a great business. And I think, I do think that he reduced the number overall that he was going to raise just from that simple conversation. Like, why? Why two? Why not five? Why not one? And I think if you can just do that without too much fat in that number, you'll get to something that, you know your business better than anyone else in the world. So don't let investors steer you to write a bigger check. Because it's very expensive. You give up 10% of your company without even knowing it, or 20 or 30. And it's just, wow, on a few hundred grand could change the difference of maybe 5 or 10% of your company. Like that's wild to me. I was very close with that. I did not give up equity easy, and worked out.
In that conversation you had though, like going from 2 million to 800K, was the runway significantly shorter after your conversation, or was it the same?
Well, I mean, he was still thinking about the same. I think he had more of a scaled idea in there, right? So the 800 to 2 billion was more a lot more units that he would sell and so on and so forth. And I said, well, if you get to that point where the backlog is there, trust me, capital will be waiting at your door. And not always. And I know that there's this cyclical nature of this, but he certainly did not need it all right then. He still had plenty of runway in the business. Um, yeah, he wanted a bigger number, and I think part of it was validation. Yeah,
And I imagine, I mean, there's safety also. There's more money is certainly a comfort, I suppose, even though it's less money for you. And when you're ringing that bell at NASDAQ, God willing, um, how do you, how do people, how do you exchange that? I mean, it's obviously it's a balancing act, but like, and you're building your company in stages, but like the whole safety aspect, like,
yeah.
only need what you need to survive, I guess. What is, in your mind, a decent runway?
Oh, geez. I was fortunate to because we never raised money. We were profitable very early on. We had to be, and by profitable, I mean ramen profitable. I mean we'd break even for a very long time, and I paid myself a very very low salary. Um, and so I think everyone's risk tolerance is different. So it's hard for me to answer that question. I would simply say that you know how much you need, and you know how much you know the ego or the pride or what the investors are willing to sell you on is kind of in addition to. So as long as you know that. But listen, I mean, everyone's situation is different. I
Mhm.
didn't have children at the time. We could do really anything. I was betting more on myself, and I wasn't. I could really think about me and the small group of people that we employed at the time, and so I just had a completely different risk profile than probably many people do. But entrepreneurs, like, they got into this because they do, carry some comfort with risk, and so I think it's more what the business requires, but I just don't do it for the wrong reasons, right? And I think if you can unpack what you need the dollars for, and truly be honest with yourself that this is not because you want this or that flashy office that overlooks the bay that has the better view. Don't do any of those things. I mean, it's so easy. You tour it, it looks great. The employees are going to love it. You're going to be the man or the woman, awesome, but it's unnecessary to build your business. So just resist that urge and do what's best for your company financially and what's best for your customers, and you're set. Yeah.
There's obviously there's no magic number. But like at your first company, how did you figure out how much to pay yourself? Was it kind of a top down or bottom up thing, like kind of
It
like
was, yeah, it was
tip
what the
payout?
business could afford.
Okay.
Honestly, it was I uh, I did not pay myself. I might have paid myself 50 grand out of the gate, only once the business could afford it. And once I could quit my other job too, by the way, right? So like there's a period of time that there wasn't, there was no money. But it was small for a long time. And I realized I could live fine with that. As long as I could pay my rent and my bills, solo, and I had a roommate, right? So we're splitting those costs. You could get by. And yeah, that avoided, I think, probably needing to raise more earlier, if you could just keep your burn as low as possible.
And were the first people on the team contractors or full-time employees?
They were full-time employees, but we did everything, and I think a lot of people do this. It's still, I mean, it's kind of required. Everyone is wearing multiple hats. And, I do see sometimes founders go out and say, oh, I need a big sales leader and I need a big this and a big that. And those are very expensive hires to get the right people. And I genuinely think that the longer you can run it and understand, like, you'll learn more about the business, you'll fix more problems, than bringing in somebody and letting them kind of go. So you need that unfiltered edge intelligence, we say a lot internally, and you gotta have to stay very close to the edge. And um, yeah, I would avoid those big hires that you need, unless it's just absolutely something critical to your business, until you start to make your incremental. No one will be a better seller than the founder of the business early on. I mean, there's no way.
I want to pivot for a bit. It was a piece you had in Inc.com, I guess, last fall. I'll put it in the show notes. People can read it. The case for raising less money than you can. Lessons from building a $2 billion company. And I was interested in one of the lines you wrote that you didn't want to raise it all, I guess, before you didn't want to raise it all before your Series A. What was the specific constraint that pushed you?
To raise the Series A,
Yeah,
yeah, we raised the Series A in the summer of 2019. Honestly, Travelers Haven could not. The business was taking off. It was pulling us faster than we could keep up, and um, we needed to hire more. Once those constraints, the opportunity was there that we were unable to tap into. We needed to raise more. So, frankly, Travelers Haven could only take us so far, and the opportunity pool was much bigger than it could take us. So, we needed to capture the market, not for security,
mhm.
not to cover a burning, a burning business.
I'm wondering, did you have investor relationships before you went out and started fundraising?
So we didn't really fundraise. So back to the earlier point where they were, that's how I learned the business when they were inbounds.
Mhm.
They're inbounds, and I just started taking those calls more seriously.
Got it.
Before we would kind of, shrug them off, but we knew that we started to see a line of it was not going to be sustainable, even though I had two companies that were growing very well. The cash needs were going to outstrip what the company could do. So yeah, we started taking those calls.
Is it fair to say that inbound interest from investors is a pretty solid product market fit signal?
Absolutely, absolutely, yeah.
Okay,
Yeah,
cool.
I don't know. And I'm sure that the tech now is even better, but they found us and we were pretty under the radar. So kudos to that group and Mickey at Telescope. They were inbound and he came to my office even, and I wasn't even going to really meet with him. And he said, "Hey, I'm going to be in your space." And he came by, and that's what started it all.
Did you, it's kind of funny. It's like trying to find out, like, why someone, like years after you start seeing someone like, oh, why did you fall in love with me? But did you ever have that conversation as far as what it was they saw in you that made them reach out? So
Yeah, I mean, I think
like
one of the
specifically.
yeah, well, if you look at how the business was performing, I was a solo founder that had never raised money before. We were doing $100 million in GBV and fully bootstrapped business. Um, we clearly had the right fundamentals, right? We weren't lighting money on fire. And so the thesis is you add a little bit of money to something that's already successful, you're going to be able to get more out of it. And that's what it was. So yeah, yeah, he had his profile pretty dialed in.
Mhm. I mean, one of the other things you mentioned was you kind of avoided like splashiness and noise early on, and I'm kind of wondering why, and I'm also wondering how that may have played into how you were perceived by the investor community.
Yeah, for some reason, I know that it helped. Probably, going back, I don't know if it would have made more sense to be more splashy earlier, but that wasn't why we were raising the money in the first place. And so it really wasn't a big part of the whole thing. It was, we needed this additional capital to accelerate our already successful business. And that's what we did it. And so anything outside of that was just not really a factor.
So, what are some of the mistakes you've seen other, we can change the names to protect the innocent, but what are some mistakes you've seen other founders make when they're raising, and it could be seed, it could be Series A, but before they've really found product market fit, I guess that'd be Series A, really.
Yeah. Well, we say conviction with rationale a lot here too, and you have to have the rationale. And I think there's a lot of times people don't have solid rationale behind some of the things that they're doing. And raising money without solid rationale, why this or with whom, it all matters so much. And you need to be able to explain why you need that much money and why that partner is the right partner out of all these other, various partners. And so I think the mistakes that I think people make are they don't have good rationale when they go into it. It is for simply validation or press release or to get the bigger office and the shiny things for the team well before the business is in a position to do those things. Eventually, sure, you can do that and the company can pay for it. But I think just too many people are making the wrong decisions for the wrong reasons.
Do you think taking money too early can actually delay product market fit?
Oh, absolutely. Yeah. I mean, think about. I mean, listen. There's a lot of great investors out there, and I think there's a lot of investors that are well intended that are probably not doing a good service to their portcos. But think of an investor like they might have an idea for your company, and before you have a fit, like they take you in the wrong direction because maybe they know somebody, maybe there's an introduction, and now you start to try to build something for someone else that's not your original vision, and you just had somebody maybe save your company or write a big check. Who are you going to be beholden to? The person that's there with you, right? That wrote the check. And yeah, I think that there's so many companies that are taken off track by outside influences. Could be called mentors, advisors, investors. Again, I think well intended a lot of the times, but so much self doubt as a founder creeps in, especially if it's your first time.
Right.
To say no to someone that's been there, that's done that, I think is extremely hard to do. And so you really do need that intestinal fortitude. You need to say, like, this is what we're doing. You need to be on board with this vision, or you should find another investor. But it is a one-way door. We were talking about this earlier. It's not like, you make the wrong hire and you can part ways. I mean, you have somebody in the business for a long time and you got to be really simpatico with them. And it's tricky, because again, you see money, but I would say the lower valuation all day long to have the right partner than a slightly higher valuation in the wrong partner, without question.
I mean, apart from not needing their money,
Yeah, sure.
well,
Have them be friends.
yeah, I'm saying, like, but apart from not needing their money, how could a first-time founder like develop that kind of thick enough skin? If someone comes to you and you didn't reach out to them and they're saying you're doing so great, can we talk? That's got to be a real reality distortion field in and of itself. Like I remember talking to a screenwriter one time. He came home and there was a post-it note in the fridge saying Steven Spielberg called, and he
Oh,
thought his life was going to be different from that day on,
yeah.
and like it kind of wasn't. And so, if you're a first-time founder, like how do you fight that? How do you create a
Uh,
framework that's going to keep
I
you
mean,
level through?
that's why you're doing the podcast. It's hard. It's hard. I think you have to have, again, back to conviction with rationale. I mean, you need to have both those things and you need to be able to change your mind too, but also understand for the right reasons. I mean, every company will pivot multiple times to finally get where they end up. But if you do it too soon and you chase or follow someone too long, I think that's where you can kind of go astray. So if you're the founder, you have more context than anyone else in the business does. We say context is worth 100 IQ points. Somebody outside that's spending a little bit of time with you here and there, sure, they do some due diligence, they understand your business, but they are not experts in your product and your market, most likely. Certainly not at this time with your company, with your team, at that stage. Like, you know so much more. So I think you have to be grounded in what you're building, knowing that you're going to be willing to pivot some here and there.
Hmm.
But I think there's a lot of people that get pulled off course. I think a lot of the best investors see those folks with the vision and help support them and maybe pressure test here and there, but they're not trying to steer you in one way or another to satisfy some sort of investor narrative.
And maybe as specifically as you can, what are some of the red flags first-time founders just miss because they're so excited someone wants to invest?
Oh, geez. Who the partner is, who the person is at the other end of the table. Um, Critically important you're aligned with that person. And don't over-index. What is it? Expect the best, plan for the worst. Don't over-index on what you think that they'll do for you. Right? You're going to wake up, there's going to be a little bit more money in the bank, and all your problems are still going to be right there. And maybe they can help, but plan for them not to, or expect them not to. It's tough. And I think some people think that once you do this, all these things are going to go away. And frankly, that's not how it works.
I'm paraphrasing. You said equity is just it's really expensive. Um, what do founders misunderstand about dilution early, other than, they're not, it's not a long-term play, obviously, to give away too much of your company too soon. But is it really just, are people just really overlooking that so simply? It seems like a really obvious thing. You wouldn't want to dilute your ownership too early, but why do people do
No,
this over and over again?
people throw around in these early days equity, um, like there's unlimited amounts of it. I mean, yeah, there's 100% of the company, and once that's gone, it's gone. And early days, I mean, take it as far as you can until you need to raise money. And if you need to raise money sooner, take the least amount that you can. Again, if you're building a good business and people believe in you and you believe in what the product is, more times than not, you're going to be able to raise money again. And so I think showing constraint up front and not getting too excited is just so important. I mean, you look at some of these companies and how much they've raised, and my goodness, the amount of dilution, and how, for me, it's making sure we had the right people on the cap table mattered a lot, and making sure that we were not just beholden to some investors that were going to switch everything off, just like kind of take us in a different direction or have a lot of sway over the business direction was just was scary for me. So we really delayed it as much as possible.
I mean, what are some of the ways that raising too much money too early can also like just hobble you down the road as far as just things you can't do or choices you can't make?
Raising too much early, I think, again, like, you're going to make a lot of those same mistakes. They're just going to be 10x bigger.
Like
And
structured, or like kind of like the way, like, the way deals will, like, for example, if I'm trying to get someone out the door, like, can I basically make that difficult with the term sheet, basically? I don't know.
oh yeah, totally. I mean, I think that part is one of the most overlooked parts of the whole thing, because it's complex, it's confusing for somebody new. You've never seen this before. Now AI, I mean, honestly, you can upload a term sheet and say, to tell me if this is on par with others or market, or it's not. But I don't think people fully realize how dirty some term sheets can get versus clean. I was very fortunate. Our first investor was like, I didn't even know what he meant right at the time. He's like, I always keep the terms are going to be clean. You're going to be able to understand it. You're not going to hate me in 5 years when you realize what all this means. And certainly I had my own counsel and they tried to counsel me in this, but the time at a small time attorney, they weren't Silicon Valley. They didn't know all the ins and outs. So I was very fortunate there, but very important to understand how the mechanics of these things work, because raising money is not all equal.
How did retaining control, like affect the way you built Engine? I mean, it's like a sliding doors question. You can't see into an alternative future, but I kind of wonder, like, are you aware of some of the choices that you didn't make?
I'm more aware of them now. I think we could have raised a lot more money in both the Series B and Series C. We were offered a lot more money. And I think about the cap table and I think about the dilution and I think about what would have changed. And I don't know how much. I would have had a few hundred million more in the bank right now. That's not why I'm here, right? We've got plenty of money in the bank to do what we need to do. Um, and yeah, the ownership would just have looked a lot different had I done the B and C in those other terms. And so, frankly, I like where we are. Hindsight's 2020. You never know. But I think that we made the right calls. And um, again, if there was something big enough that we wanted to do that the current balance sheet couldn't support, I know that we could go out and get the money that we wanted to do. So yeah, it was better to delay that than do it sooner.
Before we wrap up, I want to leave listeners with a practical framework, like a usable decision-making framework for whether they are or aren't ready to, start working on a pitch deck and start pitching. Um, if I were a first-time founder listening right now, what are some like signs? I mean, it could be anything, like, it could be signals from customer, but what are some signs I'm actually ready to start talking to VCs? Like, what are some of the pain points I should be experiencing, or what are some of the things I should be thinking about that I can't do today because I haven't gotten that first check yet?
You have a few
And
customers.
I'm thinking about seed stage at this point, not Series A.
Yeah, you have a few customers, or you have some customers that are ready, willing, and able. That you, as the founder, are in front of those customers, doing those calls. You're not overbuilding, you're not over-indexing. But yeah, I mean, I think it's the most important thing is you actually have people that are interested in the product or the concept of the product that you have. Um, that's where so much work is. I mean, you think about like look at the vibe coding right now. Like things can be spun up in no time. But I think what people don't realize is the amount that goes behind it to actually get it to market, to actually get somebody to give you money for it. And certainly there's some great cases of somebody building something and it kind of takes off. But what is the saying? Most overnight successes are about 10 years old.
Hmm.
And I think there's a lot that people don't realize that certainly the engineering side was a long pole in the tent, but there's a lot of long poles in the tent to build a business. And I think one is getting somebody that's willing to give you money for whatever that idea is. That's certainly a very, very important step. So I would start there. And when you get some of that and you can't take it any further, you literally can't take it any further, then I think it's time to start to have conversations.
But
But before,
repeatability, basically, like that's a kind of a like you have to have repeat
yeah,
business. Okay,
but
that's
you can
amazing.
do so much more than you think today, like so much more. And I think you've got to exhaust a lot of that. You got to take it to the edge, and then I think you start to raise money. When you start, as soon as you have an idea and you start thinking about raising money, like it's way too soon. Just get back to work, and
Mhm.
then get after it. Yeah.
Okay. All right. Let me just drop one on you. Finish this sentence. You probably don't need venture capital if.
Um, if you don't have a good use for the funds.
Okay.
A good use, not a use, a good
Right.
use, and clear rationale behind it.
It's like not just like, oh, I could hire, four new engineers, but more like I could build something specific with those four engineers.
That's right.
What I'm taking away from this is like you're using, capital to kind of accelerate things that are already going well, not to jumpstart things. Is that a fair characterization?
Yeah, back to, I mean, I could answer that question. You just asked me a couple different ways, and I was just thinking about like how I should have answered it differently. But I mean, I think, yeah, when the opportunity um, isn't pulling you forward, it's not time to raise money. I mean, it has to be there. It has to be tangible. Either a customer saying they want this and they'll pay for it, or some other like direct relationship you've built outside that is going to um, purchase your product or use your product. But the opportunity has to be bigger than just your idea, and it's got to be tangible. Yeah.
This has been a great conversation. We can end it there. Eli, thank you so much for the time and perspective. I appreciate it.
Thanks, Walter. Really appreciate it, and yeah, thanks, my friend.
The Fund, Build, Scale theme was written by Michael Tritter and performed by Michael and Carlos Chairez. Michael also composed Ocean, the track you heard at the top. If you enjoyed the episode, please subscribe and leave a rating. It helps more people find the show. You can get the Fund, Build, Scale newsletter on Beehive, follow along on Instagram, and if you have a guest suggestion or a question, reach me at fundbuildscale@gmail.com. Thanks for listening. Fund, Build, Scale is a production of Truth and Soul Media, LLC.